In Chapter 4, we continue our review of basic accounting, looking at using the financial statement data for analysis. We're also continuing with DeLeon, the Florida nut people who expanded in 2018. As reported, the results were not good, and DeLeon's board of directors and shareholders want some changes made and quickly. DeLeon's management has taken a hard look at things and projected their best estimate for results for 2020. Starting with their projected balance sheet on the asset side, DeLeon is projecting a significantly improved cash position, while accounts receivable and inventories do continue to rise. On the liabilities and equity side, more positive progress is expected. All liability accounts decline, with DeLeon's reliance on less debt the most significant. They expect to achieve this by issuing common stock and using the proceeds to reduce debt. On the income side, sales are expected to increase along with cost of goods sold and other expenses. The big change is the bottom line. DeLeon forecasts that they can turn things around in 2020, going from a $160,000 loss to a $255,000 profit. Shareholders will definitely be happy to see the stock price recover from a dismal $225 to over $12, a significant increase over the pre-expansion price of $850. The firm is also expecting to return closer to their pre-expansion dividend payout of 22 cents per share, again making shareholders happy. Their source of funds is the issuance of 150,000 shares of new common stock. The main focus of this chapter is using financial statement data for ratio analysis. Ratios are useful for a number of reasons. They standardize numbers and facilitate comparisons. They highlight weaknesses and strengths. They make comparison in several directions easy, versus industry averages, versus peers or aspirant firms. DeLeon could have compared themselves to Frito-Lay, or versus previous years in a trend analysis. There are hundreds of ratios, many general, some industry specific. We're going to focus on 5 main categories of financial ratios: liquidity, asset management, debt management, profitability, and market value. All ratios in the first 4 categories are derived from data in the financial statements we reviewed in Chapter 3. The 5th category, market value, requires the current market price per share. So let's go through the list of ratios we'll be covering. Liquidity. Do we have enough current assets to meet our current liabilities? Current ratio and the quick ratio or the acid test. Asset management. How well are we using our assets to generate sales? Inventory turnover, days sales outstanding, fixed and total asset turnover. Debt management. Are we using debt effectively? Debt ratio and times interest earned. Profitability. Are we making money? Operating and profit margin, basic earning power, return on assets and return on equity. And market value. Price earnings ratio and market to book ratio. Let's look at these 15 ratios for DeLeon and analyze our findings. Using DeLeon's forecasted data for 2020, their current ratio is going to be 2.34. Current ratio is one of the few ratios that has a definite benchmark. Current ratio should be greater than 1. A firm should have more current assets than liabilities. Most other ratios have to be compared to something to be meaningful. Last year, another firm, or industry average. The quick ratio is basically the current ratio with inventory removed from the numerator, since inventory may not be a very liquid asset. A firm's quick ratio may well be less than 1 depending on their level of inventory. To put these ratios in context, let's compare them to DeLeon's previous years and industry averages. Their current ratio is expected to go back about where it was before the expansion, but it's still below the industry average. And remember, industry average is just that, an average, a C grade. A firm really wants to be better than average. As with the current ratio, their quick ratio is also rebounding to pre-expansion levels, but is also below the industry average. So where do industry averages come from? Well, there's several sources. Standard & Poor's publishes some for a fee. The most widely available is probably from RMI Associates. RMI used to be Robert Morris, but they changed their name to Research Metrics. They publish averages by SIC code, categorized by firms who made a profit, and all reporting firms in the SIC code, broken down by market capitalization. Inventory turnover looks at how many times a year a firm sells out all its inventory. Bigger is better. This is definitely a ratio that requires comparison, as it's highly industry specific. A grocery store would be expected to turn over its inventory many more times per year than a firm that makes earth-moving equipment. DeLeon's inventory turnover numbers are going the wrong way, down. Reasons for the decline in turnover? Could be that DeLeon has old inventory, a serious problem for a food company as old inventory is not sellable. They might have poor inventory control. Whatever the reason, this is an area where improvement is clearly needed. Day sales outstanding measures how long it takes to convert accounts receivable into cash. Remember, in finance, we're concerned with cash. When a firm makes a sale, it's booked to sales and to either cash or accounts receivable, depending on whether it's a cash or credit sale. Ideally, accounts receivable are converted to cash as quickly as possible, so the smaller the DSO, the better. DeLeon's DSO of 46.44 is probably too high, especially if the industry standard is 30 days net. DeLeon is clearly collecting on their sales too slowly, and it's been getting worse, and they were already above the industry average. They need to seriously evaluate their credit and collections policies. Both of these asset turnover ratios measure how well the firm is using its assets to generate sales. The numbers themselves are meaningless without some comparative benchmarks. Fixed asset turnover is not back to its pre-expansion level, close to 10, but is well above the industry average. Total asset turnover, however, is declining, driven by DeLeon's heavy holdings in accounts receivable and inventory. Debt to total invested capital measures how much debt the firm is using. Note that in this ratio, debt includes both short-term, notes payable, and long-term debt. Total invested capital is equal to notes payable, long-term debt, and total equity. Times interest earned looks at whether the firm is earning enough to pay the interest on their debt. Bigger is better. Based on their 2020 projections and with the infusion of cash from stock sales used to retire debt, DeLeon's debt ratio has declined substantially and is well below the industry average. Their TIE for 2019 was driven by their negative net income, which they have turned around but are still expected to be below the industry average. Profitability ratios are fairly self-explanatory. It's the firm making money on its sales. Operating margin measures whether the firm is making money before taxes and interest are considered. EBIT to sales. Profit margin is the true bottom line, net income to sales. Basic earning power removes the effect of interest and taxes. This number is very influenced by what industry the firm is in. And here are our comparisons across time and versus the industry. Operating margin was very bad in 2019. It is projected to improve in 2020, but it is still projected to remain below the industry average. Profit margin was very bad in 2019, and it's projected to improve in 2020, but it's still below the industry average. Basic earning power removes the effect of taxes and financial leverage and is useful for comparison. Basic earning power is projected to improve, and it's still below the industry average, so there's definitely room for improvement in all of these. These return metrics, return on assets and return on equity and return on invested capital, measure how well the firm is using assets to generate profit. How much profit is generated for $1 of equity and what return is generated on total invested capital. These are ratios that would be of interest to investors. All three ratios have recovered somewhat, but are still below the average. Note that the wide variation in ROE across 3 years. This illustrates the impact of leverage, debt, on ROE. Think about these two return ratios. Consider the balance sheet. Holding total assets constant, if debt increases, equity declines. More debt equals higher interest expense, equals lower net income, equals lower ROA, since the numerator declined but the denominator didn't change. The effect on ROE is harder to gauge since net income declines in the numerator, but equity in the denominator declines as well. Now we need market price per share for our market value ratios. DeLeon forecasted a stock price of $12.17 per share and earnings per share of $1.0231 for 2020, yielding a PE ratio close to 12. Far superior to previous years, not up to the average yet. Market to book measures the market price per share to book value per share. Like current ratio, this should be greater than 1. A market to book ratio less than 1 implies investors could buy the firm for less than book value and sell the assets at book value for a profit. There's a lot wrong with this assumption. Book value says nothing about liquidation value. Book value is an accounting number. If market to book is less than 1, it implies that investors do not think management is doing a good job using assets to generate sales and profits. DeLeon's market to book has rebounded, but it is still below industry average. To give some intuition to these market value ratios, P/E ratio measures how much investors are willing to pay for $1 of earnings. Market to book measures how much investors are willing to pay for $1 of book value. Higher is better for both ratios. P/E ratio in particular is driven by investors' perceptions of expected growth. We've looked at only 15 basic ratios for De Leon. Some look better, some worse. So how do we know what to focus on? The DuPont Equation, or DuPont identity, was started by the DuPont Corporation in the 1920s as a way to break down ROE, the main focus of investors, into components to identify trouble areas. ROE is equal to net income divided by equity. In the expanded equation above, sales and total assets cancel out, leaving the basic ROE equation. But the components break ROE down into profit margin, operating efficiency, total asset turnover, asset use efficiency, and equity multiplier, debt utilization, making it easier to isolate weaknesses. Looking at De Leon's DuPont equation over the last 3 years, 2018 was below average to begin with. 2019 was a disaster with a negative profit margin and high equity multiplier, high debt. Their estimate for 2020 turns things around, but their problem is in total asset turnover, too low versus industry averages, and driving the ROE down. Numbers are great for comparison, but there can be problems. Comparing to industry averages is fairly easy if the firm being analyzed is in a single industry, Lowe's versus Home Depot, McDonald's versus Wendy's. But what if it's a conglomerate, like GE, who makes light bulbs and aircraft engines? Insiders could have access to division data, but outsiders will see consolidated statements. Even with all firms following generally accepted accounting practices, there's quite a bit of managerial discretion as to how some numbers are handled. As we've seen, without a benchmark for comparison, it can be hard to know if a number is better or worse. As we mentioned, industry averages are just that, averages, the C level. A firm should aspire to be better than average. Seasonal factors can distort ratios. There are whole books written on window dressing techniques. And inflation can distort numbers as well. Beyond the pure numbers, some qualitative factors should be considered. Is the firm tied to a single product, pet rock, a single customer, Walmart, or a single supplier? Continual product development and improvement is critical to long-term success. Think Apple. If a customer represents too high a percentage of your sales, they control you but have not invested in you. Sears in the past, Walmart now. Many firms find that consolidating up and down their supply chain gives them more control. Nowadays, most firms either sell overseas or source product or raw material overseas. This exposes firms to, at the least, exchange rate risk, as well as potential political problems overseas. Warren Buffett has said, if you've got the power to raise prices without losing business to a competitor, you've got a very good business. If you have to have a prayer session before raising the price by 10%, you've got a terrible business. What are the future prospects for the firm? What about the legal and regulatory environment? Think pharmaceuticals. Heavy R&D expense coupled with strong regulations and long-term liability. All of these need to be considered along with the numbers when analyzing a firm. This ends Chapter 4 in our review of accounting.